to my channel. In continuation to the last video, in this video today, let us going to do few problems based upon your money market hedging. Okay, so when we do the problem, let us try to understand what sort of issues arises and how do we deal those sort of issues. What are the things which we need to put in mind when we do the problem based upon your money market hedging. Now, without making any delay, let us start with the problem. Indian importer having a liability of 20,000 USD, rupees per dollar, bid, ask. Spot is given as 74.6, ask is given as 74.9, 3 months forward is given as 75.5, 75.9, money market per annum, deposit percentage is given, borrowing percentage is given, dollars it is 6% and 9% respectively, rupees 7% and 11% respectively. Money market hedging, you are required to find out and demonstrate the process of the money market hedging. You are also required to do the cost of forward, and you are required to advise whether it is advisable to go with the money market hedging or it is advisable for you to go to the forward contract. That's what is the given situation. Now, first, let us see what code is given. Here, rupee per dollar. What is the meaning of rupee per dollar? The denominator indicates the commodity. Here, the denominator is nothing but the dollar. As the denominator is dollar, ultimately what is it called as? The code is called as direct code. So ultimately the code is, when the code is direct, the price is nothing but your currency. The commodity is nothing but your foreign currency. I mean, the price is nothing but your home currency. The commodity is nothing but your foreign currency. That's what is the first thing we have to analyze before getting into the problem. So here, our key takeaways here is what? The code is direct. That's what is the point number 1 to be considered. Next, after considering the code, our next step is to identify in what position you are into. You are in a position of a importer. As you are in a position of a importer, you have to make the payment in foreign currency. As you are supposed to make the payment in foreign currency and the code is direct, will be generally buying or selling the product. Here, buying or selling the commodity. What is the commodity in the present case? The commodity in the present case is nothing but your foreign currency. So ultimately what you are supposed to do? You are supposed to buy the foreign currency. As you are buying the foreign currency, what the bank will do? The bank will sell. So ultimately, which rate is required? Ask is required. That's what is the only one precautionary measure you are supposed to consider when you are doing any sort of problem in your Forex management. Clear? So two things. One, the code is direct. As the code is direct and you are in a position of an importer, you are supposed to consider the ask. Why? You are buying the foreign currency, the bank is selling the foreign currency. Perfect. Now, let us get into the process of your money market hedging. First, what I need to do? I need to understand, I need to identify what we are having. Importer, you are an importer. So ultimately what you will have? Foreign currency liability. That's what is nothing but your step number 1. It's quite simple. Then, as I know what is my position, I need to create an opposite stand. What is my opposite stand here? In my balance sheet, I am having a Forex liability. So ultimately, I need to create an opposite stand which is nothing but your Forex asset. So now, I need to buy some sort of investments in US. If I want to buy, I should have some money in my hand. If you don't have money, then what you have to do? Go to bank, borrow. Which bank you will go? As you want to borrow and invest in foreign currency, the borrowal should happen in domestic currency. So go to bank in India, borrow some funds, convert that to foreign currency, invest that in investments in US. That's what is the process we need to do. Now, the question is, how much amount should we borrow? What is my liability? Your liability is nothing but 20,000. When you will pay 20,000? 20,000 will be paid after 3 months. Because the contract, the rate given there is what? The rate given there is 3 months forward. That means you need to make a payment. Your liability has to be discharged, not now. The liability has to be discharged 3 months later. So I'll be also creating some sort of investment, not for now, for the period of 3 months. So ultimately, after 3 months, I had to pay 20,000. As I need to pay 20,000, I should always have what? I should always have 20,000 rupees in hand. So if I borrow X money, invest in US, ultimately after 3 months, that money should grow to what? That money should grow to 20,000. So ultimately, I have to borrow such money which is equal to the present value of the Forex liability. Now, when we call the present value, I need to discount it. At what rate I have discount? Not at your borrowing rate, at the deposit rate. Why at the deposit rate? At the deposit rate, because this money will be deposited in the investments in US. At this rate of interest, it will grow. So the 20,000 USD liability has to be converted to the present value at the deposit rate, which is given as 9% per annum. But it is 9% per annum. You want the rate for 3 months. So what I will do? 9% into 3 by 12, if I do, I'll be getting something which is nothing but your 1.5%. Now, automatically to convert that into present value, your future value is nothing but your 20,000 divided by 1 plus R. What is your R here? 1.5. So ultimately 20,000 should be divided with 1.015. That will give you the present value of the present situation. That much money in dollars, if I deposit in US, ultimately that will grow to my 20,000. That's what is the given situation. Now let us quickly go through here. Identified you are having a Forex liability. Creating an opposite stand Forex asset. To create a Forex asset, you should borrow the money. You have to borrow the money in your home currency. So now the question is, how much amount I have to borrow? As my deposit is coming to, my liability is coming to 20,000, I have to borrow the present value of my 20,000, so that if I deposit that somewhere, that will grow to 20,000, so that I can sell my investments, get 20,000, and I can make a repayment of my foreign currency liability. That's what is the thing which you are supposed to calculate. So now the present value of the Forex liability is what? 20,000 divided by 1.015. That will give you the amount in your foreign currency value. Now, once we arrive at that, now the next important question is, what is the corresponding equivalent value of its INR? Okay, so let us try to calculate the present value. Then let us discuss on how do I convert that to INR. Present value comes to $19,704 USD approx. Now, let us get into the other stand. I need to know what is the equivalent value of this 19,704 in rupees. What is the equivalent value? For this, I need to know the quote. We have already analyzed the quote is to be direct. Now, as the quote is direct, what we'll do? We'll buy the commodity. As we are buying the commodity, what the bank will do? Bank will sell the commodity. As bank is going to sell, what rate is required? Ask. As the conversion is happening today, I need to consider the spot. Ask spot, which is nothing but your 74.9 has to be considered. Now what is your ask rate there? 1 USD is equal to 74.9 rupees. Then ultimately, how much dollars you are having? You are having 19,704. So you want 19,704. You want to buy 19,704 USD. For buying this 19,704 USD, you have to give some sort of consideration. As you are buying that, the banker will sell you the 19,704 USD. As bank is selling you 19,704 USD, I have to consider the ask rate. Always we have to think from the bank perspective, but not from the importer or exporter perspective. Now, 1 USD is equal to 74.9 rupees. 19,704 USD is equal to how much rupees? That means what I will do? 19,704 into 74.9 is going to give you 14,75,830 rupees. That means what? If you give a consideration of 14,75,830 rupees, bank is going to sell you 19,704 USD. Now what you are doing? Going to a bank, paying him 14,75,830, taking this 19,704 USD, investing that in US. So once you invest this 19,704 USD, it will grow at 1.5% for 3 months. That will become what? 20,000. So you are investing it at 19,704. That investment in 3 months will become 20,000. Then what you will do? You will realize your investment. I will be getting 20,000. I need to pay 20,000. So what I will do? I will simply settle my liability by getting 20,000 and by making payment of 20,000. That's what is the entire process of your money market hedging. Now, how much amount you are gaining here? See, indirectly, if you observe this particular situation, what happened? Earlier, in your balance sheet, you are having a foreign currency liability. Now, what happened? Foreign currency liability got adjusted with your foreign currency asset. Then, if you observe, what is there? You are going to bank in India, borrowing the money at 14,75,830, converted the domestic borrowing, converted the foreign currency borrowing into domestic currency borrowing. Now, you are having in your balance sheet a liability which is mentioned at 14,75,830 rupees. That's what is the ultimate mechanism which is happening in your foreign money market hedging concept. Now, we need to step into the second aspect. What is second aspect? Calculation of cost of forward. So I need to calculate something called as cost of forward. How do I calculate? I need to buy 20,000 USD. When? Not now, 3 months later. That's the reason what I had done. Today itself, I had entered into a forwarded contract with my banker at bid rate 75.5. That means bank will buy at 75.5, bank will sell at 75.9. Now, as already we have discussed, in the present situation, what is happening? Bank will sell. So as bank is going to sell, what rate is required? Ask is required. So ask future 3 months forward rate will be considered in the present circumstances. What is your 3 months forward? 75.9. That means 1 USD is equal to 75.9 rupees. 20,000 USD is equal to how much? That gives you your forward cost. Once we calculate that, we can compare that with your money market hedging, right? So let us quickly do the second aspect, which is nothing but your calculation of your cost of forward. Let us see, calculate the cost of forward. $1 is equal to 75.9. 20,000 USD is equal to how much rupees? So 20,000 into 75.9 is going to give you 15,18,000 rupees. That's what is the second part. Now finally, the last part of the problem says what? Advice. Is it advisable for us to go to money market hedging, or is it advisable for us to go to forward contract? Generally, wherever your cost is less, that is the advice, that is the thing which we need to do. So here, if I go as per forward contract, I had to pay how much? 15,18,000 rupees is the money which you are supposed to incur. Then, if I go to money market hedging, earlier we have discussed that domestic borrowing is coming to 14,75,830. You have converted your foreign currency liability to domestic currency liability. So ultimately now what is the principal value? 14,75,830. This you need to make a repayment along with the interest. What is the rate of interest in your India rupees? 11% per annum. So it is 11% per annum. If I convert that to 3 months, because you are need to make a repayment after 3 months. So that gives me 40,585. The rate of the amount of interest which you are going to pay is coming to 40,585. Principal amount is 14,75,830 plus you are paying an interest of 40,585. Total put together, your total cost in money market hedging is coming to 15,16,415 rupees. So ultimately, if you go to money market hedging, you are having a savings of what? 18,000 minus 15,16,415. The difference of 1,585 rupees is going to be your savings. That's what is the way you have to analyze and you have to do your money market hedging. So in this video, we have discussed the problem based upon your importer point of view. In the next video, let us try to discuss the same money market hedging concept from the exporter scenario. So in the next video, we'll discuss from the exporter's point of view, and other very interesting and important concept we'll try to discuss, which is nothing but your interest rate swaps. We'll try to understand what is the meaning of swaps, then how do the swaps work out, what are the points we need to understand regarding the currency swaps. That's we'll try to understand, right? Keep watching. If you have not subscribed yet, please subscribe to our channel. Keep watching.